This is yet another new low for the Indian currency, and the real effective exchange rate is one of the many metrics on which you can judge whether rupee is overvalued or undervalued. But that's not the only metric. Yes, indeed, rupee was overvalued as far as RE is concerned some time back, and now it's no more. It's rightly valued or maybe slightly undervalued. But when you have a very high current account deficit, which India has currently, it's quite obvious that you can't hold on to the currency for long at the level which Reserve Bank of India was holding on. So a weak economy has to have a weak currency. So there is nothing new about it. It's quite obvious. And historically, whenever we find that the local currency remains stabilized or rock solid, or even gets gains vis-a-vis dollar for some time, this kind of sudden drop always happens. So there's nothing surprising about it. Well, yes, there are impacts both on the economy as well as on the banking system. Our fiscal deficit is likely to go up because when you have oil prices, you have to pay more for the oil. So that oil subsidy, you need to have more oil subsidy. You need to have more fertilizer subsidy. To that extent, your fiscal deficit would go up. By the same logic, because of rise in the imported cost of oil and other things, this will be an impact on inflation. To what extent, that's a matter of calculation, because we need to see to what extent the Indian corporation can absorb the shock and to what extent they would pass on the burden to their consumers. So there will be an impact on inflation as well. And of course there will be impact on corporations' ability to finance loans, because they need to, those who have not hedged their foreign exchange exposure, they will take a hit, and anybody and everybody who will go for their foreign currency loans, their cost of money will go up because your hedging cost will go up. And finally, the most critical impact will be, all of us were expecting Reserve Bank of India to cut its policy rate in its quarterly review by the month end, but this, unless the rupee settles down, this is unlikely to happen. There are three options. A, Reserve Bank of India should use its foreign exchange reserves judiciously and skillfully to hit the speculators, to iron out the glitches in the market. It can't arrest the fall, but it can definitely iron out the glitches. And if it hits the speculators, I think the normalcy will return to the market and stability will come back to the currency. That's option number one. Option number two, I think the banks can start offering higher rates to the NRIs to mop up NRI deposits. And the third option before the Reserve Bank of India, which the country has done in the past, is the diaspora bond, the proxy sovereign bond. But for that we need to wait, because at this point of time, when the going is bad, if India goes for a proxy sovereign bond, it has to pay more. So I guess once the stability returns to the market, maybe a month down the line or 2 months down the line, it will be wiser to mop up about 10, 15, 20 billions from the global market, from the NRIs, to shore up our foreign exchange reserve and build a war chest.